What's up, everyone? It's Scotty with MoneyVest. So in this video, we are going to be talking about one stock that actually may be undervalued right now, given that it is down quite a bit from its all-time highs, and they are going to be reporting their earnings next week. So it is down a little bit over 19, closer to 20% from its recent highs, from its all-time highs. And like I said, they are going to be reporting earnings next week. As always, if you enjoyed this video, find it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. And there is a 16% annual discount that's available till the end of this month. So that will give you access to all the buy and sell alerts, options alerts, trade ideas, everything included, as well as the members-only private videos and the intrinsic value spreadsheets as well. So links are going to be down below if you're interested in joining. So the company that we are talking about today is going to be none other than one of the largest shipping and courier services, and that is going to be FedEx. And FedEx reports next week their numbers on Wednesday, right when the FOMC is, September 20th, post-market, so after the markets close, and the EPS is going to be at 376 on a non-GAAP basis, GAAP basis 355 on just a little bit under $22 billion of revenue. Now, FedEx's revenue obviously gives us a lot of insight into how the global economy is doing, because FedEx and UPS are the two largest courier services in the world. And if they are shipping a lot of goods and services, then of course we know that the businesses are booming, economic growth is there. But of course, if you see a contraction in the revenue, that does suggest that, okay, maybe businesses are not shipping as many goods, or maybe there's not as much demand from consumers. Now, there are several other factors that could also affect the revenues. It's not just the decline in the shipping of goods, but there's also fuel cost, there's also competition, there's currency fluctuations, because these are e-commerce, these are global companies that are, working with so many other e-commerce companies and retail companies and shipping goods and services like all over the world. So there's a lot of other factors, but at the core, it still gives us a good representation of how the global economy is doing. So it's going to be a good, really, really good, insightful earnings report that comes out all on September 20th. Now, when it comes to the revenues, they have consistently grown. They have doubled their revenue since 2014, from $45 billion to over $90 billion. A very, very nice, consistent, strong growth there. And gross profits have also doubled from $12.3 billion to $24 billion. So very nice, consistent growth here in both revenues and gross profitability, as you guys can see. Operating income has been a little bit more fluctuating, but it's gone from $3.9 billion to a little bit over $6.4 billion here. So not quite doubled, but very nice, consistent growth here in operating income as well. Net income has also been very similar to operating income, which has been a little bit more back and forth, but it has, on a net basis, gone up from $2.3 billion to almost $4 billion. And shares outstanding have gone down by about 2% per year. That's exactly what we want to see. We want companies that are buying back shares. And of course, diluted EPS has also fluctuated, very similar to net income. Revenue per share has consistently grown as the revenue has grown and share buybacks have happened. And EBITDA also has moved in the right direction. And dividend per share has also gone from 65 cents to over $4.71 per share. So right now, 471 divided by 254, that's about a 1.85% dividend yield is what the company is paying right now, which we will account for when we are doing our intrinsic value calculation. Now, levered free cash flow has also been very much back and forth, and primarily because of the heavy capex, and it's gone from like $3.5 billion to over $6 billion in capital expenditures. And as a result, the free cash flow has gone from $813 million to $2.8 billion. So it's still grown because the operating cash flow has grown, but in some years they have definitely had a lot of capex with little to no operating cash flow, and as a result, it was negative free cash flow for the company. Now, in terms of margins, we are sitting on about 27% gross profit margins, which is a little bit lower than the sector median, and we got EBITDA margins at 11.7%, net margins at around 4.4%. So again, it is not a software company, not a technology company, so you can expect higher margins for this company. And we got free cash flow margins a little bit over 3%, which again is lower than the sector median and is lower than the overall average, but it's a little bit higher than the FedEx's 5-year average as well. So that's actually a pretty good thing. Return on common equity is 15.5. We do need to work on the capital and the asset return, which again kind of boils down to the profitability, because the company needs to do a better job in kind of becoming more efficient in the way they run their business. Now, net income per employee has gotten better, so that's good. Earlier, it was $7,000 per employee in profit. That's a 5-year average, and that number has grown to over $9,200. Now, balance sheet is a little bit of an issue because the company's only sitting on less than $7 billion of cash and a little bit over $38 billion of debt, which brings their net debt at $31.4 billion. That is definitely very high. And current ratio and quick ratio is a little bit over 1.2, 1.3. That's pretty good. Debt to free cash flow definitely very high at over 21. That's primarily because of the lower cash flow, lower free cash flow, and a higher debt level for the company as well. Now, valuation's low. That's one of the reasons why, if you do our intrinsic value calculation, you will see that the expectations for the company in terms of earnings and the valuation right now does seem like it's a little bit more dislocated, and would not be, I wouldn't be surprised if it actually ends up being a little bit undervalued right now, considering that the estimates we're about to make. But 16 to 14 times earnings multiple, we got enterprise value to EBITDA at 9, and price to sales trading at under 1, and price to cash flow at 7 to 8 times. So that's definitely, certainly a lot lower. And this right here is going to be that earnings expectations. They're supposed to go from $17.60, expected to go up to $37 per share. So more than double in the next 5 years. And that's going to be a growth rate of about, on average, close to 16%, which is quite interesting, right? 16% for FedEx in terms of that EPS growth. That is a growth type stock while also paying you a dividend of close to 2%. Free cash flows have grown by just under 13% in the last 10 years, and shares outstanding have gone down by about 2%. So, if you come over to the chart, of course, the all-time highs were back in January and May of 2021. The stock price is still down 22% from its highs. But of course, since October of last year, it has done really well, up over 88, 89%. So we'll go over the technical analysis in just a minute. But dividend yield of just under 2%. $64 billion market cap company, very consistent in the way that they have grown. Revenues, profits, margins, everything that we just went over. So I'm not going to go with 16%. In fact, I'm going to go with a little bit modest 12% growth rate here for net income for the company over the next 5 years. Free cash flow growth rate, 12% is what the last 10 years have looked like, but it's also very inconsistent. So I'm going to go with 10% here for free cash flow growth. Multiples wise, right now it's trading at 14 to 16. I'm going to keep it steady at around 14. And free cash flow multiple, right now it's trading at 7, which is really, really low, 7.5. I'm going to keep it at 10. Okay, I'm going to expect some multiple expansion here from the company over the next 5 years. Discount rate, we're going to keep it at around 10% because, again, they do pay out a dividend of about 2% here. So margin of safety is going to stay put at 10% and minus 2% in share dilution. And, of course, we're going to do 50-50 for the EPS versus free cash flow, the weighted average. And we get to a fair value of close to $189 per share. And the market price is sitting at $254, meaning at least a 25% pullback needed in order for this stock to be trading at its intrinsic value. Now, the interesting thing is that if I tweak the inputs just a little bit, right? If we go with a slightly higher growth rate of 14%, that keeps the PEG ratio intact at 1. And we do a free cash flow growth rate, which is in line with the last 10 years of 12% and a 12 times free cash flow multiple, we get to a fair value, which is closer to $219 per share, which only warrants a 13% pullback for the stock. But again, I would be a little bit more conservative. Like I said, I'd rather be conservative and right than be aggressive and wrong. And for those reasons, maybe a 20-25% pullback would be reasonable for FedEx. And then I would be a lot more interested in this stock. Now, speaking of the technicals, this right here is going to be a very strong resistance here. At $270. Seems like we got rejected here. This is the weekly chart, so we have been selling off for quite some weeks for FedEx, and the support level next is going to stay put roughly around 245, 248. So that's exactly where we're bouncing off of. This right here was a potential bull flag breakout, so we got a huge rally over there for FedEx, and then we got another bull flag here, and then a huge breakout to the upside. So if you do end up selling off a little bit, then low 200s would be ideal for this company, for this stock at 220s, 219s. And of course, my fair value is at 189 right now. So we do definitely need to see a little bit more downside here for FedEx before it starts to become very, very attractive from a fundamental standpoint. Now, debt levels are something to take note of because that's the only thing that concerns me a little bit. This is the uptrend, right? So higher highs and higher lows. So very nice, consistent uptrend. If it does end up breaking down below 248, after the earnings, I wouldn't be surprised if it does make its way down to 219s, 220s in the future. But that right there is going to be that level to watch for FedEx. So hope you guys enjoyed this video. Not quite undervalued, but again, 20-25% downside needed. And again, if you do tweak the inputs, it does only need a 10 to 12% downside. Maybe 219, 220s could be a level where I could get a little skin in the game, start a position, especially in my dividend portfolio, because it's a good dividend payer. And it's been consistently increasing its dividend per share as well. So let me know in the comment section down below, what do you think about FedEx? As always, if you enjoyed it, found it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. 16% annual discount available till the end of this year, end of this month actually. As always, happy investing. I'll see you all in the next video.